Hey guys, are you looking for the secret to successful stock market investing? You want to know how long you should invest in stocks to get maximum benefit and return? In this video, we're going to uncover the best stock market investment strategies to help you navigate the volatile world of stocks. Whether you're interested in long-term investments or you want to learn how to invest like Warren Buffett, we've got you covered. So let's dive right on in. So number one, whenever I think of stock investing, I think about cable TV now and all these people on there telling you all this stuff to do, and they're looking for the next great stock that's going to have this big run up and you're going to make all this money. And to me, that's the opposite of what stock investing is. And I think I'm joined with some pretty good company. I mentioned Warren Buffett, and Warren Buffett's pretty famous because the holding period that he looks at is an infinite holding period. In fact, I have an entire book, an entire philosophy written about the idea that you buy cash flow assets forever. He said if you wouldn't think of owning the stock for 30 years, don't think of buying it for 30 seconds. Because investing, to him and to me, and I can't speak for Warren Buffett, obviously he's one of the greatest investors of all time, if not the greatest investor of all time, but I believe that I can articulate some of his philosophies based off of his writings and what he says during his shareholder meetings and everything else. And it kind of boils down to this, that Wall Street makes its money on activity and you make your money on inactivity. You make your money by buying really good companies that are easy to understand, that have strong moats, strong protection around them, that make good money and share it with their shareholders. That tends to be what we focus. He looks at excellent value investing. In other words, things that you can go out there and if you calculate it correctly, you can see that it's undervalued, that the assets of the company are worth more than the share price lets on, and you can come in and buy a decent opportunity. Now, I know that that's probably very, very difficult for some people. They're going to look at it and go and say, I don't know how to do all these valuations. And I don't think you necessarily have to. But I think the philosophy is sound in that when you buy for the long term, you're not buying and hoping that a stock goes up. You're not buying a growth stock hoping that it doubles or triples in value. Although that's apparently what all these professionals are running out there trying to do. But the stats tell us how successful they are. So number one, we can look at active traders. There's been studies on active traders, and about 95% lose money. I'm not talking about don't beat the market. I'm talking about lose money. It's gambling. And yes, there are gamblers that make money. There are professional poker players. I live in Las Vegas. I have friends that are professional poker players, and they make their living off of taking other people's money. To me, that's not investing. That's gambling. I don't want to be in a situation where I feel like I'm taking something from somebody else. What I want to be in is in a position where I'm participating in the growth of an excellent company. And so I don't want to gamble. I don't want to put myself in that circumstance where I have about a 5% chance of success. Instead, I want to put myself in a situation where I have a 99% chance of success. I want to be the casino. I don't want to be the gambler. And how do I put myself in that situation? I'm going to invest in the long haul. Here's the facts. There's a study done, Spiva, and what it does is it looks at professional money managers and how they rate against a benchmark. A benchmark might be the S&P 500. It might be large cap, mid caps. There's different definitions. But let's just say against the market. Hey, okay. Can you beat the market? You're a professional money manager. Over time, can you beat the market? And I'm not talking about, hey, did you do it for 6 months? I'm talking about year after year. And let's talk about a 15-year stretch. How many professional money managers beat the benchmark? About 8%. In other words, if all you did was say, you know what, I don't know, I'm going to buy the market, you would do better than 90% of the money managers out there. And I know those guys are screaming right now saying, hey, wait a second, that's a benchmark. It's not exactly what it seems. Well, maybe it is. Maybe these people aren't paying anybody and they're going to actually get that extra return. Maybe they don't need to go and follow somebody else's advice on what they should be investing in. And better yet, maybe they can just pick a few companies of their own. I know there's this idea of diversification out there. I run a different model. I look at diversification far differently than a lot of the brokers out there and some of these folks that follow some common thinking. They think, oh, it's hundreds of stocks. I think that I'm joined also again with Warren Buffett, who says just pick a few really good companies. And so I tend to focus on diversification in terms of different types of asset classes and different segments. I'm not really worried if like you have one or two or three or four. Like I actually think it's probably about less than 20, but more than 10, right? Good companies in different sectors of the market. So, maybe you have consumers, maybe you have energy, maybe you have a REIT, whatever. You're just spreading it around the marketplace a little bit. You're not putting all your eggs in one basket, but you get good companies. And the beautiful part about long-term investing is once you start saying, you know what, I'm not interested in the short term. I want to know how things are going over decades, not months, not weeks, not days. I'm focusing on decades. Then it becomes, the world gets very, very small because there's very few companies that are strong over that long horizon period. A lot of these startups, a lot of these growth stocks go boop, 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 over and over and over again. Look at WeWork. Look at a bunch of the car companies. Look at all this. It's like you boop. So you want to make sure that you're buying something that's going to be steady Eddie over time. And I do that by looking at companies that have profit and then share it with their shareholders. So I tend to look at the cash free flow, how much they actually make, how much they pay out to individuals in the form of a dividend. And so I focus on those companies. And I look at them saying, do they have a competitive advantage over a long period of time? So when you look at like a Warren Buffett portfolio in Berkshire Hathaway, which you can look at, hey, it's out there. You can absolutely pull up and see everything he owns and what percentage he owns. He's a publicly traded company, so it's all disclosed. And you can see exactly what they own. He's got the Coca-Cola, the Bank of America, Wells Fargo. He's got energy companies. He has some that they own that are not publicly traded, some that are publicly traded interests. It just means that you can go out and buy the same thing. But the commonality is that they're excellent companies. Apple, he's got a ton of Apple. I shouldn't miss that. But he's buying companies that are very competitive in their industry, make good money, consistently do it. Like I just mentioned, he's got Coca-Cola. He was buying it in the 80s. People were running away. And he's looking at it going, really good company, always makes money. And it's paid off handsomely for him, right? And when you start looking at it and saying, hey, I'm not so interested in making money in the next month, I would love it if that happened, but I'm buying this because I want to hold it for a really long period of time. And it starts to narrow down your choices. We tend to look at things that have a history. So like I don't really look at companies that don't have a payout history of dividends that have been increasing for at least 10 years. I want to see companies that are over that hump. In other words, you don't want you want something that's over the hump. Hey, they're beyond, they've done well. Have they had a spike and a decline? Sometimes people go through cycles, but I'm not like overall, I'm looking at a trend line that's going nice, consistently up. And that's because they're paying out their a chunk of their profit every year. So they're not just sitting on it trying to get their stock price higher, because that's a couple of different ways you get your stock price higher is you pay out a dividend and you're dumping the cash so that there's not as much assets. So the stock price doesn't go crazy. It's not going to have these wild fluctuations. You're consistently paying it out. Or, what a lot of these companies do is they don't pay anything out and they hoard their cash and they get more valuable. So you say, oh, there's growth. Well, it just didn't pay you. That money should be in your pocket. It's in the company's pocket. So why are you giving them a no interest loan, right? I actually want to get paid. So I want that dividend to get paid out. Do I want them to pay out a dividend if it's going to hurt them? No. So I tend to look at the free flow cash, how much is there, how much they're paying out. I like to see, 60% or less payout, meaning that they have extra cash so they can continue to grow, but they're paying out a portion. I was just looking at Chevron yesterday. They paid out this last year about 30%. You look at those types of things as, hey, if they make $1 and they pay out 30 cents, they retained 70 cents to continue to grow. If somebody is paying out $1, but they only made 70 cents and they had to borrow so that they could pay their shareholders, that's not a good situation, right? So same dividend, but very different set of factors. So I tend to look at good, healthy companies, profitable companies, consistent companies. I don't see a lot of fluctuation in their growth. You just look at it going, they're steady eddies. that are growing consistently over time, and they're paying out their shareholders. And then I look for the long time horizon. And if I was picking a horizon, I would say at least 15 years, because you know that you're going through a couple cycles during that stretch. So you're not, you're looking at a company, and I'm not horribly concerned about the short term. Like if it starts to pull back, if you have a market that goes down because the Fed's raising interest rates or whatever, you're not sitting there crying if it pulls back a little bit, because you're still getting paid. You're still being paid consistently, and you know over time that this company is going to be healthy because it has a nice profit margin, and because it has lots of competitive advantages in the marketplace. So that's what I do. I tend to look at good, great companies with good profit margins, consistently over time rewarding their shareholders. I tend to use the marker of 10 years of payouts for the dividends as a minimum. I like the aristocrats where they're paying out 25 years. I like the dividend kings where they're paying out 50 years or above. They've been increasing that dividend year in and year out, quarter after quarter or month after month. And the shareholders are getting rewarded because it's transferring the money from the company to your pocket, which I prefer. And especially over a long period of time, the stock will end up being paid for by the dividends over a long enough time horizon. And then it's free to you, and then you just have a little money machine. And if we get really technical, I wrote the book Infinity Investing, I'm looking at it saying, not just your lifespan, but the lifespan of your heirs. Is it going to continue to generate income for them down the future? The answer is yes. And that is why I focus on long-term stock investing. That, and because you don't get crazy, you don't have to worry about everything that's going on currently in the marketplace. You're not worried about pullbacks, slight pullbacks. Your time horizon is a lot longer. And the easiest way to explain this to you is, in the stock market, we put a ticker over the stock and we can see its fluctuation on a daily basis, so we can freak out. If you put a stock ticker over your house, it probably caused you stress. It would probably cause you to want to do something. If your house started losing value, you might freak out and panic sell. They do that in the stock market because they're encouraging you to do activity. We have to ignore that, and we have to look at the long time horizon. In the same way, when you buy a house and you're going to live in it, you're like, hey, I don't really care. Over time, it's going to go up in value. That's great. But I don't need to look at it on a daily basis. It's the same thing. Here is, we're not going to sit here and look at this on a daily basis. We're going to look at this and we're going to say, over a long period of time, great company, going to have consistent results. You look at its past, you look at its future, and you sit there and say, as long as they're not cutting them dividends, they chop those dividends, I may be looking at dumping that stock. But if they're continuing to pay out and they're continuing to reward the shareholders, I'm just going to continue to hold and allow that thing to generate income for me. I'll add probably covered calls if I can sell calls out of the money, which means more than I paid for. I might do that to add on additional revenue streams. But regardless, it's a long process. We do not do this short-term trading stuff unless, like, that's gambling. And if you want to gamble, it's not money that you need to live on. Like, I'm not going to tell you not to do that. I have plenty of people that I know that are active stock traders. They love that stuff. But that's not what you base your investment strategy on. That's what you do is on the side. Your investment strategy is long haul. The studies back up everything I'm saying. There's been multiple studies on short-term trading. The easiest way to think of this also is if I taught you how to dribble a basketball and how to shoot hoops, and you start feeling very confident, and you go out there and there's LeBron James. I'm sorry, he's going to whoop your butt because he's a world-class athlete in that particular sport. If you learn how to trade and you get real ecstatic and you're like, hey, this is easy, this is great, I learned how to do, how to buy options and all this stuff, and you just learned how to dribble, and now you're walking onto the ball court and you don't realize that you're up against LeBron James, who's about to take your money, and that's these professional traders that have been doing it for decades, and they're waiting for all the newbies to come in and dump their money. And statistically, that's exactly what happens. I don't want that to happen for the folks that I work with. And so I'm always telling them, don't walk onto that basketball court and go against him. Just bet on the game and allow yourself to grow. You do not have to go head to head with these folks. You don't have to. You can just sit there and buy the good companies and let them pay you over a long period of time. You could avoid that conflict and that harassment and that emotional pain, because statistically speaking, again, it's not even close. And this is even worse. If you're a guy, you have about a 3% chance of success. Women are a couple points higher. But study after study after study show that if you're sitting there trying to play and time that market, it's not going to happen. There's an old adage: it's not timing the market, it's time in the market. You want time in the market, you want to be looking at that long term horizon. Do that and you'll be successful.